This is part 2 of Stephen Miran's A User's Guide to Restructuring the Global Trading System. In this part, we're going to be talking about the approaches. We previously spoke about the Triffin world and the dilemma that we are in, and so now we're going to be transitioning to changes that can be made, approaches to start to address these problems. When we're reshaping the global trading system, there is two approaches that we can take. A unilateral approach, that would be where, as the United States, we would be looking out for our own interest, taking moves without the consensus or agreement of other countries, and looking to carry out things in the way that we see fit to meet our benefit. That would allow for a lot more flexibility, would be easier to implement, however, would be a lot more likely to see undesired effects and resulting volatility. We could also go the route of a multilateral approach, which has occurred throughout history in accords. That would require the alignment of other countries with the United States, bringing on trade partners, coming up with agreement that is going to benefit multiple parties. And so as a result of bringing on more countries to that agreement, that means more people would need to see benefit to them, which is going to curtail the size of the potential gain of that restructuring. However, by having a lot more say from other countries as we move toward a mutual agreement, that would allow us to also curtail the undesired effects and damper the resulting volatility from a restructuring move. While the United States is looking to do this, it's important that we are not looking to reshore low value add industries. The example Miran gives would be textiles. So there are still going to be plenty of manufacturing industries that the comparative advantage would leave to overseas partners or other countries to continue to manufacture and export to us. However, we should still be looking to preserve high value add industry, slow down and prevent offshoring, and increase negotiating leverage for other countries to be more open to the idea of the United States exporting to them. The other thing that we need to make sure that we keep in mind is the United States intellectual property. It's been a major concern between the United States and China over the years, and so protecting the IP of the United States should remain a major part of restructuring this global system. Another part that will continue to be of interest to the entire world is the national security concerns that have come from offshoring manufacturing sectors. And so we're going to need to make sure that we look to onshore certain things that would be of a national security interest, broadly conceived, meaning that we need more industry, including things like pharmaceuticals and semiconductors are the examples that Miran gives. The one way of restructuring that the Trump administration already has familiarity with, and that we're going to be talking about largely in this video, is through tariffs. And so Donald Trump has used tariffs in his past presidency, and he saw success with tariffs in 2018 to 2019. The tariffs were able to pass with little discernible macroeconomic consequences. We will get into the details of that in this video. And so we're going to be looking at macro versus micro and getting a better sense of the results of implementation of tariffs, since we do have a recent case study, and how to do it better and make sure that it's working in our favor. The first thing that Miran looks to in terms of the economic theory was written at the same year that he wrote this user's guide, and states that in theory, tariffs should be partially offset by currency appreciation in the tariff imposing country or depreciation in the country on which the tariff is imposed. And so we're going to be talking about currency offsets and how tariffs can not necessarily in the classic sense immediately be paid and long-standing be paid by the consumer. So ways that currency may offset a tariff is first through central bank monetary policy. So if a tariff is put in place and the import prices are expected or do go up, then the central bank may raise rates to try to avoid resulting inflation. And those raised rates will cause more capital inflows because there's going to be a higher return on foreign capital coming into the United States at those higher rates, which will then in turn cause the dollar to rise. And when the dollar is more valuable, those import prices are brought down by relativity, meaning as the United States dollar is worth more, buying those prices in the foreign currency is going to be less costly to the consumer than if the dollar had not appreciated. And so that can be so offset, meaning that the currency can offset the same amount of the tariff to where you would have a perfect offset, and import price would be brought down to the same level as before the tariff. Simply due to the currency appreciation that occurred. So the tariff would still be in place. However, the US dollar would have raised in value, making it so that that tariff is no longer noticeable to the United States consumer. They're paying the same price out of their pocketbook that they would have prior to the tariff being put in place. How trade balance may offset the tariff with moving currencies is currencies will adjust to the real price people are willing to pay. So this would be where the consumer is going to interpret those higher prices as a tax, and because the demand on those imported goods should have elasticity, those people can just choose not to pay higher prices and not buy those products. And so if import prices rise for a good and are perceived as a tax, then the demand for those goods would go down, and the currency of that country exporting the good would no longer be selling as much, and so they would have a reduced amount of their currency reduced amount of their exports being purchased, which would then depreciate their foreign currency. And so the dollar could stay the same price, but instead, whoever is exporting to us, their dollars could go down. And so we could have that same offset occur through the exporting nation's currency depreciating versus, like we talked about earlier on the monetary policy, our currency, the United States currency, appreciating. The other thing that can cause currencies to move and offset a tariff would be growth prospects. And so if a tariff is optimal, which we'll speak more on that in this video, so that we can get a better sense of what an optimal tariff means. But if tariffs are optimal, they can actually improve the tariffing nation's growth prospects. And so other people around the world may see that tariff as welfare enhancing, and that it is likely to cause growth in that tariffing nation. So the United States, looking like it would grow more as a result of those tariffs, would cause investors to be attracted to that potential growth and move their capital into the United States, and that would again be pushing our dollar higher, right? So that would be an appreciation of the US dollar that would be able to offset those tariffs. And so all three of these are describing the situation where currencies will move in a way that allows for the consumer to pay the same price for the good as before the tariff as while the tariff is in place. And so again, making that clear, that would be due to the currency moving, either the exporting nation's currency devaluing or the United States currency appreciating. That would cancel out the level of the tariff. So when the exchange rates move and the tariffs entirely offset one another, that would be where we have a perfect currency offset, where the price that the consumer pays is the exact same before the tariff as after the tariff. And so for that to occur, there is going to need to be an optimal level of a tariff and an optimal tariff environment. And so what is that optimal tariff environment? The exchange rate would need to move by the right amount. And so it would need to appreciate in the tariffing nation or depreciate in the exporting nation by the correct amount for a perfect offset to occur. When a country exports a finished product, that finished product should mostly be sourced from that same nation. So if China were to export a finished product, the labor, raw materials, the majority of the process that went into making that product should have also occurred in China. Pass-through from exchange rates to export prices should be complete. The export must keep their prices in their currency. For any currency offset to occur, that needs to be the case. They cannot be exporting their products in US dollar prices and us paying US dollars for that, or it's impossible for there to be any currency offset to occur. So it's extremely important that the exporter is keeping their prices in their currency. pass-through from wholesale to retail consumer is complete. So for us to have a perfect currency offset, we should be able to expect that if a price goes up by $10 at wholesale, then the retail will pass on the entirety of that $10 increase to the consumer, right? The firm should not eat any portion of that. That should be expected to be entirely burdened by the consumer for it to be considered an optimal tariff environment. Important to understand that this is the optimal, and so these are not going to be assumptions that are going to hold perfectly. And as we said in that previous slide in 2024 with Gene and John, is in theory tariffs should be partially offset, strictly due to the nature of a non-optimal tariff environment being a more likely occurrence than an optimal tariff environment. So there is likely to be more volatility in prices in international trade and in markets as a result of there not being an optimal tariff environment, or if we don't use an optimal level of a tariff. So what would that volatility look like? If we do not get any currency offset, if the currencies do not offset the tariffs, then the importer has to face a decision. Either look for a cheaper option. So, if they don't want to pay the higher prices, they can look for a different supply chain option and look to import that from a different country, a different supplier. Maybe it doesn't necessarily need to be foreign. They could look for a domestic supplier instead as well. Volatility is going to arise because there's going to be uncertainty in those supply chains. And so it's not necessarily going to be an easy thing to look for a cheaper option. That might be costly, take some time. And so volatility would likely occur during that trade rebalancing away from the tariffed nation. That would also cause uncertainty in the investors' minds, and so they're not going to be certain of future prices, and so we would see volatility from that as well. The other option that they could do is they could just pay the higher price, and so they could pay the higher tariffed price, and then volatility will arise from the price swings by the degree of the tariff level, right? Because if the tariff level is going to cause it to be an extra $10, then the consumer is going to have to pay the extra $10. And if we decide to move the tariff down as a result of that, then the price is going to be swinging and moving along with that tariff level, and that's going to cause a degree of volatility at the price level. So let's look at the case study. 2018 to 2019, we had tariffs in place with the same president that we have today, Donald Trump, and we are going to look at the, in quotations, China trade war, which raised effective rates over that time period by 17.9 percentage points, and the renminbi depreciated against the dollar by 13.7%. So the currency moved to a large enough extent to cause a negligible upward pressure on inflation. We can look at the core inflation chart. We see some volatility throughout the period of the 2018-19, as high as just under 2.5%, as low as 2%, but seemed to resolve around that 2% area by the time of the armistice. Measured CPI moved from slightly above 2% before the trade war and was still roughly 2% by the end of that 2019 period that we're talking about here. Cross currents did exist. There was a Fed tightening cycle that was occurring at the same time, but any inflation from the trade war was small enough that it was overwhelmed by the cross currents. And so we can speak to the volatility and the nature of the 2018 to 2019 period, and certainly say that it was not an optimal, perfect world or environment. But any inflation that resulted from the tariff war was small enough that it was overwhelmed by the cross currents, which is important precedent. This is why Trump camp believes the trade war was non-inflationary. When we look at the macroeconomic picture, they have data that they can speak to say that this was a successful implementation of tariffing another nation. However, there are multiple microdata reports that are going to put quite a bit of opposition to that opinion. A lot of reports showing that prices indeed moved up by the tariff levels and there was no currency offset that occurred. So Cavalier, Gopinath, Neiman, and Yang, no currency pass-through on import prices. The firms interpreted that the tariffs would be more sticky and more permanent than the moving of exchange rates, and so they stuck with the tariff as their means of recognition of price points. But still, even in that environment, there were very few goods that saw sharp price hikes at the consumer level. So what that speaks to is that a lot of the firms were eating the tariff, a lot of the import firms. Fagelbaum et al. Found that net welfare losses of $7.2 billion because Chinese firms were not lowering their prices either. So, again, comes down to, in the beginning of this, as it was starting to be implemented, a little bit of a shock. The firms were not paying any attention to the currency movements, but were paying full attention to the tariff levels. Amity, Redding, and Weinstein saw added costs, mostly paid by the importing firms and consumer. So speaking to the Cavalier, noted tariff structures were taxing the intermediate goods too heavily and hurting manufacturing competitiveness. So this microdata also pointed out some changes that should definitely be considered when implementing tariffs, and that they felt that the tariffs were actually hurting manufacturing competitiveness versus helping it. So why do we have such strong opposing data points and the ability to infer maybe very different thoughts of what success looks like from that 2018 to 2019 period of implemented tariffing? What Miran speaks to is that the short-term effects studied in microdata are actually going to be very unlikely to see the macro picture and very unlikely to see the broader view of currency pass-through, just simply due to the nature of currency pass-through being a lot less salient, taking more time for it to be recognized and moved into the system. And so Amity et al. Referred to that lack of exchange rate pass-through and those short-term effects as a puzzle, but did speculate that over a longer time frame that the exchange rate effects would materialize. What we see in the Cavallo et al. Is that we did not see consumer price levels rise at the expectation of the tariffs. Instead, the firms did still see higher import prices, but ate a lot of the portion of the tariff. And so when we're looking at the macro consequence of that, the macro consequence is going to be paying much closer attention to the consumer price levels at CPI. And so we're not going to see those necessary firm price level increases when we're looking at the inflation data in the CPI. But what Miran points out is that even if currency pass-through did not happen in this event through this report, this situation points out that the suppliers would resolve those supply chains over time to restore margins since they were not passing those price points off to the consumer. The other what seems to be the most problematic thing about looking at the microdata for that time period, the 2018 to 2019, is China very quickly made moves to avoid those tariff rates on anything that they thought they couldn't pass the increased price to the consumer on. So what they were doing is China was, instead of exporting directly to the US to have to worry about the tariff, is they'd export to a third country and then have that country export it to the United States. And so there is provable data to show that the rerouting of China imports rose by about 50% from the tariff increases, and other data to point to that number could be closer to 90%. So if China is taking that strategy, which we absolutely need to recognize and look to mitigate if we were to implement tariffs again, then China was really only looking to directly export the ones that they had the most pricing power over into the United States, which is going to massively upwardly bias the microdata. So, pulling from that case study, understanding the microdata, understanding the macro picture, how does that give us precedent to work towards using future tariffs to continue to look to reshape and restructure a system? Well, pulling from the case study, what we can say is that even if all the expectations failed to realize in the offsetting of the currency perfectly, and that tariff pass-through remained as observed in what we saw in Cavallo et al., the fact of the matter is that even if there was a 10% tariff causing a 10% rise in prices of imported goods, if the United States dollar was able to appreciate, which we did see happen in 2018 and 2019, then the total tariff pass-through would be modest. The actual resulting inflation and resulting price levels that would come of that over a medium to long run time period would be a modest 3.3 to 0.6% of CPI. And it would be expected to be a one-time boost to the price level and just a small transitory period versus persistent inflation pushing us towards a goods wage spiral. Now, that does not mean that we can take that precedent and assume that it's as simple as copy-paste. If there are more turbulent times during the implementation of tariffs and there are greater inflationary cross currents occurring while trying to do that, it is very possible that such a change may work its way into real inflation expectations and become more persistent, which could then lead to the goods wage spiral. Excuse me. The goods wage spiral would be where, as the good prices are higher, the laborers in the United States would require and need higher wages. And so as those higher wages went up, again, to support those wages, then the prices of the products would need to go higher again. And so it becomes a feedback cycle of wages and goods continuing to inflate. But there's no such evidence of anything close to that occurring in this case study. And so Miran feels quite confident that we can look to this as precedent to at least say that, we can start to approach this without immediate concern of a goods wage spiral being a consequence. Because even if we did see some inflation start to arise as a result of implementing tariffs, there's so many other ways to battle that inflation that don't involve taking that tariff back. We could have tax reform, deregulation, and energy abundance, and they would serve as meaningful disinflation drivers that could smother any incipient inflationary impulses. I like that quote from Miran. Tariffs are not inherently inflationary, is the main thing that we're concluding from this. They can be part of an administration's restructuring policy and still have everything be overall disinflationary, because even if they were to be slightly inflationary or partially inflationary, as he spoke about, there are so many other ways to battle that inflation that don't necessarily mean we have to no longer implement tariffs. So let's pay attention to the differences and make sure that we're on the same page as the difference between a perfect currency offset and no currency offset. If a perfect currency offset occurs, a reminder, what that means is that the currencies move in a way to where the tariff is offset, meaning that the consumer prices paid before the tariff are the same as once that perfect offset occurs as after the tariff. So the tariff can still be in place and the consumers still pay the same prices previous to that tariff being implemented. So with perfect currency offset, there would be no inflation, right? So as we just spoke about, the consumer prices would be unchanged. That would also mean that because we saw no inflation, that would mean that it was paid for by the tariffed nation via their reduced purchasing power, as their currency was now weaker than ours, relative to ours. It would have little effect on trade flows because the effective import prices don't necessarily increase, as we've been speaking about, due to that perfect offset. And so regulatory reform offsets currency effects on exports. And so there's not going to be a necessary change in trade flows that occur when we have perfect offset occur. Things can more or less kind of continue as usual, and the Treasury will just continue to raise revenue through the tariff versus having trade flows change or inflation arise. If there is no currency offset, so if instead the tariff goes up, the currencies don't move in a way that allows for any offset, then that would be inflationary because the tariff is going to pass through to the consumer prices, and so consumers will be paying higher price points and cause for inflation. That would mean that the consumer goods in the importing nation would be a higher price, so they would be the ones that are paying for the tariff. The trade flows would then need to rebalance over time as the imports are more expensive relative to domestic production. So if there is no currency offset, that is going to force trade flows to rebalance versus if there is a perfect currency offset where the trade flows could continue as were before the tariff was put in place. as that trade rebalancing away from the tariffed goods occur, the Treasury is going to receive less revenue, right? Because if the tariff causes higher prices and the importers decide to look for other supplies, they're not going to be importing from that tariffed nation. As time goes on, less and less and less, they will be importing from that tariff nation. And so the Treasury is receiving revenue from those tariffs. And so as those tariffs are less utilized, the Treasury's revenue will continue to diminish. How does the currency offset impact financial markets? So currency may not cause inflation. So as we talked about, if we have a perfect currency offset, then we can have zero inflation occur from a tariff, but it will still imply greater volatility in financial markets in the short term. And so the case study we're going to look at for financial markets is 2024, where we have a case study of carry traders being pushed by the the Bank of Japan. So carry traders were borrowing from the low-rate country of Japan, who was offering basically a 0% borrow environment for traders. And they were taking that and looking to invest that borrowed money in a higher rate country. And so the same time as the BOJ stance shifted to thinking about raising rates and getting rid of that 0% borrow environment, the most attractive investment to those borrowers was in the United States, who at the same time was printing unemployment numbers that were rising and causing fear of the United States lowering their rates. So that was squeezing in that area of where they were going to be able to have a return, because they're going to have to pay more to borrow and get less for investing. And so what that caused is the yen to appreciate, and that made the carry traders need to sell their positions in the United States in order to pay off their loans with the Bank of Japan. And so what that currency offset created was an 8% drop in the NASDAQ Composite Index in 3 sessions. So if we imagine a large China tariff, 20% to 50%, a 30% devaluation of the renminbi would be needed to offset that tariff, and that would definitely, although we're not going to necessarily have to worry about inflation, it would have significant market volatility due to what we just talked about in the case study of Japan. Now, China's communist economic system necessitates strict control over their capital accounts to keep funds locked in domestic assets. So they would need to find a way around capital controls, and that could devastate their economy, in that they do not have the flexibility to work their way around that massive of a currency devaluation. So capital outflows from China as a result of currency devaluation could potentially result in severe financial stress across the global market. Therefore, if we're looking to create a perfect currency offset, we need to be very aware that financial market volatility may far exceed the worry of inflation. What would result from the possible currency adjustments in those financial market volatilities could be of much greater concern than the total pass-through of tariffs to the consumer price, right? So if we have a low tariff, it may only increase the consumer's prices by 1%. And we don't have to have any currency offset there. We would have some inflation. However, the opposite to that of perfect currency offset is we might not have the inflation and the raised prices, but we would have a very volatile financial system that we would need to be concerning ourselves with as a result of that. So what really is going to matter is whether there is a lasting effect from the tariffs, and as any investor knows, initial market responses often unwind or reverse over time. And so it's important to recognize that we should have a gradual and permanent approach to this versus a shock or a immediate reaction to any short-term effects that may result in this. But still, we need to really make sure that we're looking to keep things under wraps and not allow that volatility to totally explode and make things extremely difficult for everybody around the world. So in the 2018 to 2019 case study, we're going to be looking at how likely is it that we get these currency offsets, right? So if we look at the case study of the China trade war, we can see that currency offset was indeed effective. There were several cross currents concurrently to dissuade from considering this to be replicable. So understanding that a currency offset occurred in 2018 to 2019, does not mean that we can assume that that's for sure going to always happen in the future if we utilize a tariff. So some things that we should pay attention to was that the dollar was already appreciating more broadly than just versus China. And so although the tariffs were directly with China, the DXY was increasing by 10%. So we can not necessarily point to the exact causation of the dollar appreciating to the situation between US and China trade and US and China currencies. However, if we look at that Japanese case study, currency moves in one pair can affect other assets too. And so what that gives us precedent for is recognizing that it is very possible that the DXY was moving because the US versus Chinese currency was the major movement that was causing the volatility in the DXY index. In 2018 to 2019, yield advantage of U.S. Treasury securities was declining relative to yields on other G7 debt, despite the Fed hiking. So the expected Fed policy should be priced in by the time of those actual changes occurring. Currency markets follow expected changes, not what the Fed is doing at the moment. And so it's highly unlikely that the dollar appreciated because of the monetary policy. Instead, it likely appreciated in spite of it because but before that trade war, those Fed policies should have been priced into the situation. And so it is much more likely that the dollar appreciated due to the trade sequences versus it being a monetary policy situation. So there is still difficulty in appreciating the dollar nonetheless. And so Miran has explained to us how the, cross currents that were likely occurring, currency offset was happening in spite of some things. And so in 2025 to 2026, rate cutting environment by the Fed is going to make it more difficult for the dollar to appreciate to offset the tariffs, right? So if people are expecting for pause or cutting in the rate environment, then they're not going to be looking for much appreciation of the US dollar. And so that would be a cross current that we would have to be working against if we wanted to see the dollar appreciate. The US debt may show that there's unsustainability at hand, and that might inhibit upwards pressure on the dollar. It is now ringing around the world that the Social Security Trust Fund is likely to require more borrowing come 2033. So there are a lot of budget woes ahead, and they are nearby. However, what Miran speaks to is, this is unlikely to be too much of a concern, in the sense that most other countries are still dealing with very similar dilemmas of their own. And so relative to other currencies, again, like we spoke about about the reserve asset, it's unlikely right now that our current environment is going to prevent much appreciation, especially if we have tariff revenues to allay some of those budget concerns in the United States. But it's still possible that the concern of that Triffin world prevent much appreciation in the dollar. And if the dollar starts from a stronger start point before tariffing, so if it's already at the top of a range on that DXY index, it's going to be a lot harder to get more marginal improvements to that, versus if the DXY index is already lower on the range over the recent history, then it would be easier to move it higher. And this is something to note because in 2018 the DXY was near the bottom of a range, so it was at a point to where it would have been easier to appreciate the dollar than if it had been at the top of that range of the DXY index, for example. So there's still absolutely possible no currency offset would occur, but it seems from everything that Miran has spoken about and that we've looked at through case studies and through other reports, that it is more likely to occur than not. So how can we implement tariffs? How is the administration implementing tariffs? How do they plan to continue to implement them? How can we do it in a way that would be successful and make sure that the United States benefits? It's important to recognize that sudden shock to tariff rates can result in financial market volatility through elevated uncertainty, inflation, and interest rates attacking that inflation, or via a stronger currency and knock-on effects thereof. So we want to make sure that we understand that, throwing really high tariff rates in at a shock and awe type of level is likely to just instantly create a very high level of possible concerns. Trump cares about those financial markets, and so he's going to want to maintain his ability to minimize as much disruption in those markets as possible. He prides himself on financial markets being a representation of the President of the United States, and so it will be of great concern to him to try to keep somewhat of a bubble around that volatility and try to manage it as best he can so that he doesn't lose that side of his presidency that he values so much. And so in order to make sure that this works and is impactful in the way that Donald Trump and Americans would like it to be, graduated implementation of tariffs would be needed. And the term that is used often is gradualism. And so we want to make sure that we are forward-thinking, informing the world around of expected changes and being able to have a graduated permanent implementation versus shock and awe, high levels, retract levels. We want to have a gradual ease into this restructuring versus trying to make it a violent change all at once. There is an understanding that as we look to implement tariffs, that we need to be much more cautious of any negotiation with China due to previous abdication of agreements. And so China at this point has proven to the United States that it can't be trusted on their terms of agreements. And so it's very important that we look to secure trade deals versus work upon any sort of just mutual trust. So instead, the most appropriate route forward would be to treat trade policy like the Fed does rates and try to give forward guidance to the world with expectations and make sure that the world is ready for the next steps, that, if the United States plans to implement anything, that we create a communication to allow for those implementations to be understood and work towards goals without creating a violent amount of volatility or interrupting with markets. We need to allow that tariff implementation to occur without much adverse effect, like we saw in 2018, 2019, and make sure that we're able to put the ball in China's court to reform their practices and reform their approach to the system. This will provide firms with clarity over the path of the tariffs, allowing trade rebalancing where necessary, and it will limit the financial market volatility by removing a lot of the uncertainty. So again, really looking with future implementation of tariffs, current implementation of tariffs, needing to make sure that we do that in a way that is able to communicate to the world what is going on, what those intentions are, and do that in a way that is graduated and at a slow enough rate to where we're able to avoid as much financial market volatility as possible while still looking to restructure to the benefit of the United States. And so some plans and approaches have been produced. A major part of that is non-uniform tariff schedule. So as opposed to a tariff schedule that is 10% across the entirety of the world, to have different levels of tariffs. What Besant has struck up as the idea is buckets, and so you have a varying amount of different groups that you can be in that have varying tariff schedules, and give clear guidance on how to move into better buckets, right? And so you can reinforce the behaviors of the trade partners to move towards your ideals by having an ideal bucket that they can enter into with the most favorable trade arrangement for the nations that move into that bucket. So the things that Miran has pointed out that would be very useful to establish and evaluate where countries lie in terms of what group they should be placed into is, does the nation apply similar tariff rates to their imports from the US as America does on their exports here? Is there a fair amount, or is there retaliation going on with our tariff rates? Does the nation have a history of suppressing its currency, for instance, via the accumulation of excessive quantities of foreign exchange reserves? Are they a nation that can be trusted to allow for currencies to work in the way that we expect them to, or are they going to manipulate that to work against Americans' trade interests? Does the nation open its markets to U.S. firms in the same way that America opens its markets to foreign firms operating stateside? Do we have an equal amount of access between those countries? We would want there to be these things in order to move them to the ideal buckets, and so these questions will allow them to evaluate where nations should be placed. Just reiterating that. Does the nation respect American intellectual property rights? Does the nation help China evade tariffs via re-export? Does the nation pay its NATO obligations in full? Does the nation side with China, Russia, and Iran in key international disputes, for instance, at the United Nations? Does the nation help sanctioned entities evade sanctions or trade with sanctioned entities? Does the nation support or oppose U.S. security efforts in various theaters? Does the nation harbor enemies of the United States, example given, terrorists or cyber criminals? Does the nation's leaders grandstand against the United States in international theaters? So you can see they can evaluate countries based on certain metrics and then have a non-uniform tariff schedule to allow for these trade systems to work towards American ideals. So we can start with a small amount of criteria. We don't need to start right away at immediately looking to evaluate every single country in the world and immediately try to figure out every perfect tariff schedule. That is not going to be possible. We're going to have to start with a small amount of criteria, low rates, and gradually expand those things as we see successes where we see successes, and have the opportunity to pull back in areas that we maybe are not seeing as much success. And so a major goal here in this restructure is to figure out how to handle China. As we talked about, China shock being the term that Miran uses, and a lot of blame being placed on China for the current situation that we are in. And it seems as though the best way to move forward with restructuring is to figure out how to tame China. And so the tariff wall is an idea utilizing this restructured trade system to start to move China into the direction of being able to meet the ideals of the rest of the world, or America in particular, but what we believe would be ideal for the rest of the world as well. And so we can have weighted trade partner systems, and that can be used, as we talked about, those evaluation metrics, to put additional pressure on the biggest threat of China. So if we ask other nations to join China tariffs, or they're going to lose access to that favorable trade term by being, they're going to be in a lower bucket, and they're going to lose access to the United States security umbrella, we can start to put pressure on other countries to join us in putting pressure on China. And so we're looking to create this sort of wall around them by a multilateral approach of a bunch of different countries that may not even need anybody really necessarily sitting down and agreeing at an accord, and that we can utilize these market metrics and this trade system to start to push those reinforcement schedules onto other countries around the world. So this would create a multilateral approach to tariffing China, which Miran has designated as a tariff wall. I actually don't know if that's his specific term that he came up with or something he's using from elsewhere, but that is the term that he uses. So the trade-off for countries to choose from will be join the US in applying tariffs to China, or pay the higher tariff to have access to the United States, and if you don't agree with us on these ideals, then we're also going to pull back our responsibility for securing your country or having your national security interest be worried in terms of the alignment of ours. So for the United States, both choices can be beneficial. So regardless of which way that a country decides to go, they can have benefit arise from either choice, whether they decide to join us and get into the ideal bucket and become a willing trade partner to put pressure onto China, or they decide not to, then we're going to gain revenue from those tariffs that they decide to pay that are going to go to the U.S. Treasury. And it's going to limit our burden share of our security umbrella in expecting them to have to pay their way forward and take care of themselves in being able to worry about their own national security. So how does tariffs and competitiveness play hand in hand. Remember, we talked about that microdata study that had concerns about tariffs and manufacturing competitiveness with the implementation of tariffs in 2018 to 2019. So it's important that we recognize that the relative cost of producing exports or importing from elsewhere is impacted by labor taxation, consumption, capital, or trade. So there's a lot of different things that are going to play its hand in terms of the competitiveness. It's not going to be a direct correlation of tariffs and competitiveness in an easy two-variable equation here. There's a lot that goes on to put pressures on the competitiveness of our manufacturing sector. He points to a report in 2013 of economic devaluation of currency can be perfectly replicated by two other combinations of policy: importation tax, tariff, and exportation subsidy. So if we place a tariff on imports and a subsidy on exports, then domestic firms are going to be a lot more likely to look to move into manufacturing sectors and tradable sectors, due to the fact that importing is now more expensive and exporting less. The other approach that can be taken is a consumption tax and a payroll tax cut. And so what that would create is it's going to make the actual American workers, the American public at hand, have more spendable income, but taxing the consumption, the imported goods, they're going to favor themselves towards things that have the lower taxes and are going to change their preferences and how they use that extra money. So both discourage domestic use of goods and services and encourage domestic production. Identical economic outcomes as currency devaluations, where domestic tradable production rises and consumption of import goods declines. Both boost competitiveness in manufacturing, and this equivalency helps build the intuition for the currency tariff, right? So the idea being that both importation tariffs, export subsidies, or consumption tax and payroll tax cuts are able to accomplish the same thing. And so it gives us a good ability to look at the alignment of our currency tariff situation, offsetting currencies with tariffs, offsetting tariffs with currency. The biggest difference, though, being revenue raised, in the sense that tariffs are able to produce, I mean, likely, I guess he doesn't say for sure which one is more productive than the other. I inferred that, but revenue raised would be a dissimilarity. How much revenue is raised for the United States government is going to differ between those two approaches. Fiscal approaches. Preservation of low tax rates is a means of generating investment in jobs in America, even more so when financed in part by tariffs. So we can have tariffs in place, preserve low tax rates, and look to generate more investment and build up our employment sector in the United States. Distortionary costs of taxation are convex. And so if we look at that, what Miran is pointing out is if we need revenue, the United States government needs revenue, and so to achieve revenue, there's fiscal approaches. And then we have our trade approach here with tariffs. And if we look at the impact of raising rates on tariffs and the impact of raising rates in a fiscal perspective of taxes, then the distortionary cost of raising taxes when they are already at a higher level is going to be a much larger burden on the society at large than raising a tariff rate would be, right? And what he means by convex, I included a graph over here so we have a better recognition of that, is as those rates get higher, as those tax rates get higher, the marginal increase of another tax hike from that higher level is going to continue to be more painful. Whereas tariff rates are starting already at a much lower point on that convex curve, and so increases to the tariff rate are not necessarily going to be as burdensome as an increase to taxes would be. So therefore, the economic consequences of raising revenues from increasing tariff rate is less problematic than increase to corporate or income rates of, when we're looking at the overall welfare of the society at large. Castanet and Rodriguez-Clare wrote in 2014 about an optimal tariff. And so they went into great detail about, for the U.S., under plausible parameterizations, that a tariff around 20% would be ideal. Now, there is concerns in terms of how what we talked about earlier, right? Optimal environment, optimal tariffs. And so we do have to understand that they're talking about optimal in an optimal world, but up to 20% will continuously boost aggregate welfare in an optimal tariff world with an optimal tariff. So what we have to be concerned about, though, is that 20% rate can't just be perceived as like this perfection ideal, because there's a lot more variables that need to be concerned with. And one of the major concerns would be retaliation against that tariff. So if we have a 20% tariff and the country decides to retaliate against that, then the optimization of that tariff can change drastically. So how do we avoid such retaliation? Retaliatory tariffs will impose an optimization problem and should be avoided whenever possible. So we want to make sure that we're not looking to start trade wars, but rather looking to have, again, gradual, permanent restructuring of the trade system. And so the U.S. can absolutely withstand these trade wars better than anybody else. So Miran points to the understanding that it's not a matter of because the U.S. will necessarily be a failure in that sense. However, in order to win those trade wars, those tit-for-tat escalations, there's going to be a high cost to doing that. It's not going to end up being welfare enhancing for the United States if we end up in a tit-for-tat escalation with the tariffs. However, the United States does hold a lot of leverage in the sense that it does have a large source of consumer demand for the rest of the world and is a robust capital market that is treasured still by all the rest of the global system. The other thing is that the United States security umbrella is still very much the prominent umbrella that you want to be in favor of. And so having that security umbrella tied to trade policy will allow for massive leverage in avoiding retaliation from trade partners, people that we wish to have trade agreements with. If trade partners choose not to comply or decide to retaliate, then they will alleviate the burden share of the security umbrella and allow the U.S. to place greater focus on China. So this isn't an all-encompassing ideal in the sense that it doesn't need to capture everybody. There can be absolutely some countries that decide to retaliate, and that could still be beneficial so long as we have an overall global system to where we're not being retaliated against by a vast majority or by larger players, but instead, there might be some players that decide to go that route and not participate, not agree with us, retaliate against us, but that would just make sure that we know that we don't have to worry about our security umbrella reaching out to those countries and reduce the national security costs in terms of what the United States has to be responsible for, which again allows for larger focus on the real issue at hand, which Miran continues to point to is China more than anybody else. Trump has taken a liking to this tariff-driven revenue and leverage and is likely to continue utilizing tariffs in the future. And so although Miran speaks to none of this being relevant as policy suggestion, he points out that, if we have a president who's planning to do this, we should have a stronger understanding of what's going on and so that we can guide him on how to do this in a welfare-enhancing way for the United States of America. So that will conclude the second part of the series. In the third part, we will be reviewing currency-driven approaches.